Hello friends, a very warm welcome to my channel. In today's video, we are going to do the analysis of another very interesting company in a small cap space. It is into manufacturing of adhesives, and the stock has given multi-bagger returns in the last couple of years for its investors and created a huge wealth for its investors. But from here onwards, whether the company still has the scope of growth, whether the risk and reward is in favor of the investors to buy or not, the complete business analysis and the financial analysis we'll be discussing in today's video. So if you're new to the channel, please do subscribe and hit the bell icon so that you don't miss any new video which is uploaded on our channel. And if you're not a part of our Telegram channel, do join today as we discuss every day morning, the market analysis and a lot of other interesting investing concepts on a Telegram channel as well. So it's going to be a great learning experience being a part of our Telegram channel. So let's begin the analysis of Jyoti Resins. So Jyoti Resins is the number 2 in the wooden adhesives manufacturing brands in India. It manufactures synthetic resin adhesives. There are several types of adhesives which it manufactures, which are used in the construction and infrastructure space. The brand which is used is called Euro 7000, and it is quite popular in the north and western regions in India. They started the company in 1993, and right now they have presence in more than 13 states. So they are expanding geographically quite aggressively. So let's discuss a brief history of the company. The company was started by the chairman and founder Mr. Jagdish Patel, and later his son has also joined the company. They got the company listed in 1995 itself, so it was an early IPO, and at that time they had a manufacturing setup in Santej, which is near Ahmedabad, of over 8,000 square yards. So it was a small setup and they got the company immediately listed. In 2005, his son Utkarsh Patel joined the company as an executive director. And in 2006, they launched their brand, which is Euro 7000. 2007, they expanded their capacity to 250 tons per month. And until this, they were concentrating their business in Gujarat itself, and they started selling outside Gujarat as well. In 2010, they started selling in the Rajasthan markets. And in 2012, they again diversified into other geographies like Maharashtra. In 2017, they did another capacity expansion from 250 to 500 tons per month. And by 2018-19, the company's presence went up to 12 states and their capacities went up to 1,000 tons per month. And recently in 21-22, they expanded their capacities further and doubled it to 2,000 tons per month. And they also are setting up new warehouses for ease of distribution of their products. So over the period of the last couple of decades, you can see the company has been continuously expanding geographically, as well as their capacities are doubling every few years. Now let's talk about the management a bit. Mr. Utkarsh Patel has joined the company in 2017 and he's a chemical engineer. He has more than 17 years of experience in this industry, and he has also done his masters in marketing and international business management. Now let's talk about the business of the company in detail. The brand which the company sells through its products is called Euro 7000, and under this brand the company manufactures various adhesives which are synthetic adhesives, waterproof, anti-termite. So like this, there are several SKUs depending on the usage of their customers. Several SKUs have been developed to cater different needs of the industry. So overall, what is their business model? They import certain raw materials from abroad and they manufacture their products in India, and they have a wide distribution network through which they sell and distribute their products in India. In terms of packaging, depending on the usage, they have different packaging sizes from 500 grams to up to 70 kgs, which can be used in larger projects. And they also have different incentives and loyalty programs to boost their sales. So it's a very simple business model of the company. When we talk about the product portfolio, these are some SKUs which the company makes, which are different from each other. First one is anti-termite, the second one is waterproof and anti-termite. So like this, fast drying, there are different varieties in the adhesives which the company makes, and these are mainly the white adhesives which are similar to what we use called Fevicol, which is of the brand called Pidilite. Like this, you can see for PVC, acrylic sheets. So depending on the material which we are sticking also, there are different varieties of adhesives. So like this, they have different sizes, and depending on the weather and heat conditions, they have cold press, hot press, and big tumblers like this. Their products have both residential as well as commercial use for bigger construction projects. In terms of geography, they have presence in more than 12 states and 28 branches. They have more than 50 distributors of their products, and their sales team consists of more than 300 people now. They have touch points of more than 10,000 retailers, the shops where their products are available, and they have loyalty programs wherein they are in touch with more than 3 lakh carpenters, which get various incentives and points if they sell their products. The company has started initiating different digital marketing initiatives wherein they are creating advertisements to be circulated on social media as well as television. They have started different loyalty programs for customers as well as carpenters, because carpenters play a key role in selecting the material during the time of construction. So the buyer has a lot of influence of the carpenters on them. So this is their business model. I have kept it quite simple because it is actually very simple. I do not want to complicate it. Now let's move to the industry analysis. The global wood adhesive industry presently's market size is about $4 billion. This would reach about $5 billion by 2026, and the growth rate can be expected to be about 10 to 12%. So the industry itself is growing at a double-digit growth. So it's a high growth industry where this company is operating. In terms of competitors, the biggest elephant to compete with this company is Pidilite, because if you are building a house, it is not easy for you to shift from adhesives of Pidilite like Fevicol, because you have trusted that brand for your house or your commercial projects for a very long time. So you can't easily shift to a new brand which is manufactured by a smaller company. So the toughest competitor for this company will always be Pidilite, and some other new well-known brands like Astel are also venturing into the adhesives category. So like this, people who are in the construction ancillary space, those companies as a means of diversification further are entering this space, which will create this space a little more competitive going further. There are smaller players in the listed space like nickel adhesives, HP adhesives, and there may be several regional unorganized players as well. Now, how is this company different, or what is the economic moat of the company? The company has a very asset-light model. You will know that you can check that the asset turnover ratio is quite high for the company. The manufacturing cost is low, so the margins are quite decent. They have a diversified product portfolio, although they manufacture a single product segment, but within that segment they have several SKUs. The management is quite well experienced. They have experience of more than 2 decades. The infrastructure is well developed, which is not easy for a new company to develop in this space. The brand is quite well known in the north and western part of India, and in terms of leadership, it is the second largest brand in India in the adhesives category. Now, what is the growth outlook the company is giving going further? The company expects their growth to be in the range of 25 to 30% CAGR in terms of revenue going forward, which is a very good growth, and the recent capacity has doubled from 1000 tons per month to 2000 tons per month. In terms of return ratios, they are expecting to maintain very high return ratios, which is very attractive for an investors. They are expecting a ROE about 30% and ROC about 40% going forward as well. There will be new products which the company will be launching across different categories to diversify their portfolio. They will be foraying into new geographies because they are just present in 12 to 13 states right now. So there is a huge market which is still unpenetrated for this company. They will be setting up several warehouses because distribution of these kind of products is not easy. So they will have to have a local presence in every state in terms of stockist, warehouse and other dealers to penetrate into the markets deeply. So these are the growth plans of the company going forward. Now, while doing this, what are the risks or challenges the company might face? The biggest challenge as per me for this space is competition. The company has to compete with players which are equal in size, which are in unorganized segment, as well as people who are in the organized segment like Pidilite. The raw material prices will be volatile, so the company has to hedge those prices to maintain the margins. The company has exposure in only one segment, which is a big risk as per me. The company has to diversify their products into different categories so that this risk gets mitigated going forward. The company has dependency only on the construction or infrastructure space. So if this industry witnesses a slowdown, the business of the company would be impacted to a large extent. When the company diversifies into different geographies, the product's acceptability will be a question, because people have been using certain brands over a long period of time, so they may or may not accept this new brands in the new geographies, and this cost advantage or high return ratios or high margins which the company is getting presently, going forward as they scale up, these may get also normalized. So that kind of impact can be there on the financials also. Now, after understanding the business completely, let's move on to the financial analysis of the company. The revenue has been growing very well in the last 3-4 years. They have gone up from about 50 crores to 180 crores, which is a huge jump in FY22. And in the trailing 12 months also, this momentum is continuing. The EBITDA has gone up from about just 2-3 crores to about 20 crores, which is almost 10x in the last 4-5 years. And that's why the stock price is also going up quite well. The EBITDA margins have slightly improved up to 16% in FY20, but due to inflation, they have again normalized to 10 to 12% in the last 2 years. The profit after tax has shot up from about 1 crore to 20 crores in the last 4-5 years, and the profit after tax margins have improved to about 10 to 12% in the last 3 years. The share capital has gone up to 12 crores recently because the company has issued a bonus of 2:1 in September 22. The reserves are steadily growing because the company is a continuously profit making company. The borrowings are zero, so it's a debt free company, which is a good indicator for an investor like us. The trade payables are under control, they just are about 2 crores. The fixed assets are steadily growing because you've seen throughout the journey the company is continuously doing capex every 2-3 years. The inventory levels are in control. The inventory days are just about 36 days, so they are managing their inventory quite well. The trade receivables are just about 64 crores, but in terms of trade receivable days, if you see, they are gone down from about 300 days to about 120 days, which is about 4 months presently, but still they are slightly on the higher side. So for such brands which are unpopular, they generally give a lot of credit to the people to penetrate the markets. So going further, we have to see whether the debtor days are going down or again they are rising, which is to be closely watched in this company, by which you can judge whether their products are selling well and their money is coming to them fast or not. The cash position is fine. They have about 24 crores of cash on the balance sheet, and the operating cash flows have always been positive in the last few years. In terms of free cash flow, the company is doing decent free cash flows. In the years in which the free cash flow is negative, it is because of the capex done by the company. In terms of ROCE, these are very good numbers. ROCE about 46% or above 40% is very attractive for investors. And in terms of shareholding, there are no institutional investors in the company. The promoters and public hold about 50-50% in the company presently. The promoters have slightly increased their holding in the last few years. They have increased it up to 50.8% from about 47%. So this is also considered a good sign from an investor's point of view. Now let's talk about valuations, which is another critical part of our analysis. There is no like-to-like comparison for this company, but still overall, let's see the historical valuations of the company. The market cap is somewhere around 1450 crores and the company does a revenue of about 236 crores. So in terms of market cap to sales, the company is trading at somewhere around 6 times. The last 5 years median market cap to sales is just about 1 time. So the valuation in terms of market cap to sales is on the higher side. In terms of PE, the company trades at somewhere around 50 and the historical PE in the last 5 years is somewhere around 23. So in terms of earnings multiple also, the valuations are expensive. In terms of price to book ratio, it trades at a PB of about 19 times and the historical PE is about 5 or 6x. So in terms of book value also, the multiple is on the higher side. So because of the growth and the recent share price movement, the valuations have become rich for this stock, and the risk reward is not in our favor if we enter the stock at these kind of valuations, unless you are putting a stop loss to protect your downside risk. The bigger players in this industry like Pidilite trade at a PE about 98 and market cap to sales of about 11x, but their track record, their stability in business, their long performance in the last few decades is altogether in a different orbit. So you can't compare a company like that and give the similar valuations to a company like Jyoti Resins. So these kind of valuations do not give us comfort as investors to enter it at these levels. If the similar performance continues and the stock price is down maybe about 25-30% from the current levels, then the risk reward slowly can get in our favor as value investors. The stat auditors of the company are Messrs. Suresh R. Shah and Associates. The ROE is about 34%, dividend yield is 0.2%. The director's remuneration is about 2.34 crores and there are no suspicious related party transactions in the company. So if you look at the chart, it was a sideways chart for a long period of time, and post-COVID it has given a very big movement. After a jump, there was a consolidation in the range of about 700 to 800 range, and then there was another rally up to 1750. So now the stock is in a downtrend, and at this point of time the risk reward is not in our favor as value investors to get into the stock. But in terms of valuation as well as the support on the chart, if we get in at somewhere around 750 kind of levels where there could be support on the chart as well as valuation comfort, that kind of entry level would be comfortable as value investors for us. So this is about Jyoti Resins. I hope you like the analysis. To summarize, the company has good fundamentals and they have a good growth track record in the recent few years, and they are also expecting a 20-30% kind of a growth going forward. They will be adding new products, diversifying into new categories, and the market in which the company is operating is good, as the industry itself is growing in double digits. They are doing continuously capex and doubling their capacities every few years. So considering all these things, Jyoti Resins appears to be a good investment. In terms of antithesis points, there is stiff competition in the space and the competition is bound to increase going forward. The acceptability of the product will be a question when they diversify into newer markets. The raw material prices volatility will be a challenge to maintain these margins and return ratios, and the company has a risk of single product dependency. They don't have a diversified product portfolio. If there is an industry slowdown, the business of the company will be impacted because they are focusing only on a single industry and not into diversified set of clients. So this is about Jyoti Resins. I hope you like the unbiased, in detail analysis, and I hope this helps you to take the right decision of investing in the company. If you like the video, hit the like button and share it with your friends and subscribe to the channel. Don't forget to join our Telegram channel. And if you want me to make videos on your favorite stocks, do leave the name of the stock in the comments below. I will surely consider this for the upcoming videos. Thank you for watching and have a very wonderful day.